Thank you. Thank you. Was that George?
No. That was Jim from Michigan.
Oh, Jim. Thank you, Jim, so much. We just need a couple more to vote and we'll end the poll. The poll says that we have 0, except for me from Alaska, 60% Pacific time zone, and 30% from Eastern time zone. Let's see if I got anybody else that needs to be admitted. So I'm going to end the poll and tell me if you can see that. Let's share the results. Okay, can you see the poll results?
Yep.
And scroll down. We have 0 overseas, 0 Canada, 0 Alaska. What is going on?
Well, it's not that cold yet.
So it's always very interesting to me to see a turnout, and thank you for those. We had 41 of 45 answering the poll of the location. So that's always quite interesting to me. We're going to stop sharing that one. Okay. Sure. Close it down. So I think maybe I'm closed here. Number 2. Leveraged exchange traded fund ownership. Do you own TQQQ or SOXL, or do you own both of them? They both have been in a buy zone. And do you currently own a different? We got about 50% participation so far. Feel free to vote on the button there. We've got about 70% participation so far. Just a couple of more you vote and then we'll close her down. I don't want to go too long on the polls. So I'm going to give it about 5 more seconds here. Of those that own an LTF, let's see, 42% TQQ. And only one of you own SOXL. That surprises me a little bit, but that's fine. There's no right or wrong answers here. And 21% own both. And 33% own something other than TQQ and SOXL. So that's interesting to me. I'm really not wanting to get poll fatigue here, but I've got a really important question that I wanted to ask everyone. We've been starting here for the last 14 years. We've been starting at 7 p.m. Alaska time. Should we stay at 7 p.m.? Should we start at 6:30 or 6 p.m., which might be a little more user-friendly to our folks down south? Or would you like to meet on a different day, like a Saturday, say, for example? So I'll give you a little bit of time to answer that one. We got 50 people here so far and 80% participation in the voting. I'm going to end the poll and show the results. 70% of you say that you would prefer we start 1 hour earlier. I'll take that under strong consideration. It's just respect and understanding for people in the lower 48. Fortunately, we've been recording meetings and folks have been able to participate by watching the recordings. So thank you for the 47 of you. We had 92% participation. So just quickly, I want to turn Eric loose here, but I want to just briefly share my screen. If we look at the big picture real quick, market trend. Hope everyone's doing well. Stock market falls on hot inflation report. Okay, let me try that again. Let's share our screen. You see the big picture now?
No. Has anyone else seen it?
Nope.
Okay, so let's about now.
Yep, there we go.
Okay, I gotta.
Can somebody mute?
Do not unmute everybody.
I don't have the power. If you can give me the co-host or something.
I took care of it, Floyd.
Thank you.
Yeah.
Great. So stock market falls on hot inflation reports. If you were watching it today, things were looking really great, and then it started rolling down. On Thursday, indexes closed off a session lows, but finished solidly in the red. The Dow Industrial dropped 0.5, S&P 0.6, NASDAQ 0.6, and the Russell, wow, down 2.2. So you'll notice we picked up a distribution day the first ones in this new confirmed uptrend, one on the NASDAQ and one on the S&P. It says for Dow, Walgreen Boots Alliance was the best performer, surging 7.7%, or excuse me, 7% after company's earnings results. Still, shares remain 40% off the 52-week high, so that's pretty interesting. Top growth stocks follow the market trends lower. Innovator Fund went down 1.7%. Adobe jumped 2% Thursday after a new high before backing off a bit to close. So I'm not going to read this whole thing because we do have the guest speaker tonight, but I recommend that every day you read the big picture. This little short video is usually pretty interesting too. I try to watch that every day and just encourage you to keep yourself apprised of the market and know when we're in a confirmed uptrend and what's happening with individual stocks or with interest rates. So I'm going to introduce Eric. Eric spoke to us last September when he did version 2 of the dollar cost averaging strategy. Eric works as a senior product manager for a Fortune 500 financial technology firm near Columbus, Ohio. He specializes in creating management, data, and analytics solutions for customers around the globe. Eric, I made you a co-host. Do you see where you can share your screen?
Yeah, I see it.
Thank you so much, Eric, for agreeing to share your strategy with us tonight. I find it quite fascinating, and I think the others will too.
Great. Let's see if I can share. And
When you share your screen, I think if you just double click on the screen image, which is probably to the top left.
it's asking me to open my system preferences, and for some reason, it's not letting me open them.
You want me to do it?
Yeah, do you mind?
Okay, I don't have it loaded, but it just take me a second. I know right where it is, and I will load it up.
Actually, do you mind if I send you the most recent version?
Sure, do it right now.
Okay.
Bear with us just a little bit, folks. We'll be there.
All right.
It says I can't minimize my screen while I'm recording. What am I going to do now? Let's see.
If you hit your start button, you can navigate between your windows.
Let's try that.
Okay, I sent it to you, Floyd. Let's see here. Hold on a second. Oh, screen share. Maybe I've got it here. Hold on. Window size. It says share individual window. I don't see anything here that's preventing me from doing it. It's very strange.
Did you send it to the TQQ investor?
Yes, I sent it.
I'll bring it right up. Okay, I've got it. Hey, Billy, can you?
It.
Okay, I'm going to go to slideshow and from the beginning. So that's visible.
Yep, it is to me.
Okay, that should be the one I pulled up. Is there any mark or anything you made so we know if we have the right version?
No, I'm sure it's fine. We'll be all right.
And if you want to do that poll number 4, we can do that one too.
Do you want to just wait till the end?
That's fine. We can
Do that. Thanks for having me here. I'm pretty excited to share this, actually. I've been working on this quite a few hours, and I'd say upwards of at least over 100, doing a bunch of back testing with this. So I'll just jump into it. If you want to move through the slides here, it's just really for educational purposes. I definitely encourage folks on this call, if you're interested in this, certainly do your own back testing. I think you'll be amazed. Some of these leveraged ETFs, if you pair them correctly with the right non-correlated ETFs, you can actually tame them pretty well. So I just wanted to recap. The last time I was here, I talked about this TQQQ, dollar cost averaging. Essentially, the two strategies were buying more on down months and then buying more when down 30% during the month. The results are on the screen here that I showed in the meeting. And then, as Floyd mentioned, if you had started that strategy after that meeting, you would be up 60% currently. There were always these two issues with the strategy. The first one was this whole issue of drawdowns. I gave some mitigating strategies, but it just bothers me that you'd have to sit through a 96% plunge during the 2000 collapse, and then during 2008, 92%. And then go to the next slide, Floyd. And so issue 2 is you'd have to sell, right? If you want to mitigate that. If you're doing this in a tax advantaged account, maybe that's not a big deal. I actually was trying this strategy a little bit in my Roth, but I couldn't maximize that account because I didn't know when was I going to have to buy double on a month. And what if I don't have the funds to do it? On tax advantaged accounts, you can only add a certain dollar amount per year. That was always in the back of my mind. I can't actually follow the strategy the way I want. If you go to the next slide, Floyd. So I was trying to figure out, is there a better way? I was on vacation late March of this year. This book had just come out, Tom Basso. I don't know if many of you have read this book or not. Matt Caruso featured a few times on a lot of the IBD stuff. He was reading this book recently. Apparently he's on vacation in Florida and brought this book along to read, which I found interesting. This book is great. I highly recommend it. It's really eye-opening, the strategies that Tom lays out. Tom is more kind of strategic trading. He's employing a lot of the strategies that I'll talk about. After this presentation, you'll hear a lot about different ETFs that you may have never heard of. What Tom is doing in the book is similar. He does a lot of strategies with futures. He does strategies with cryptocurrencies, and I'll talk about that in this meeting as well. But essentially, an all-weather portfolio is really an investment strategy designed to perform well in all economic conditions, so good times and bad. And then it's really creating a diversified portfolio to provide more stable returns. So go to the next slide, Floyd. Now try to go through this and explain this. Hopefully it makes more sense. Floyd contacted me recently and asked me if I'd want to do it. And so I quickly put something together. So I had to cheat a little bit and ask ChatGPT to help me out on some of this diversification. Even if you're doing a can slim strategy, right? You don't want to have all high flying, low float stocks in your can slim portfolio. I think even IBD tells you might want to have some mega cap stocks to offset some of those high flying stocks. So that diversification, I'm sure you're all familiar with that. Balanced exposure, I'll talk about that a little bit. This risk management one I highlighted because we're going to talk about this a lot. This low correlation piece, having investments that have low correlations is absolutely the key with this strategy. Long-term focus required a lot of back testing to make sure I got it right. You're going to want to rebalance this quarterly if you choose. I'll talk about how you can easily manage this. It's really simple. If you plan to add money over time and you're in a taxable account, you're going to probably want to add money over time to it. But if you're in a tax advantaged account, rebalancing, you could do that monthly without issue. So go to the next slide, Floyd. Let's talk about some of the basics. I'm sure you've probably heard of some of these portfolios, or maybe you all have your own retirement accounts and your CanSlim account is your kind of play money account. I do run a CanSlim account. I was trying to figure out, is there a way that I can utilize extra money and create a portfolio that's an all-weather? These are some examples of what that would look like. You've probably heard of the 60-40, so 60% stocks, 40% bonds. That worked well in 2000, 2008, and everyone thought they were a genius because they had that makeup. But now in 2022, you saw how stocks and bonds were so highly correlated that they both fell, and the 60-40 portfolio got decimated. The second one is the Harry Brown permanent portfolio. I like this one, although I don't necessarily like the idea of having 25% of my account in cash. I view that as an opportunity cost. So I'll show later how you could potentially repair this one and make it actually better. And then the other one is the Ray Dalio all-weather portfolio, which has been great with this bond bull market that's been going on for 40 plus years, but that looks like that's over at this point, right? So that portfolio has also been decimated in 2022. This is some back testing that I did on the 60/40. I used the SPY and TLT. TLT is just the 20-year bonds ETF, and then of course the SPY. If you combine the two together, you can see how this really mitigated the downturn in 2008, right? If you were running just the SPY only, you're down over 50%. But the SPY TLT was almost half that, right? Really did a great job. And you look at the correlations over there on the right, I've got the SPY and TLT. You can see that those correlations are definitely opposite of each other. It was a great mix during that time frame. So if you go to the next one, go back one. Yeah, so here's 2022, and you can see what I'm talking about with how this performs. SPY TLT down 3%, corrected actually 26%, versus if you just owned the SPY by itself, you would actually be up 6.5%. And your drawdown was 23%. So this is a good example, and you can see the correlations too. Since they're over 50%, they're much more correlated in 2022. So I think this highlights the stock bond dilemma, right? For 40 years, they were not very correlated, but that seems to be changing lately. Go to the next slide, Floyd. So what I did here was I added a diversifier. What you really want to do is try to add diversifier or more low correlation into your mix. That way you can create a portfolio that is much more able to weather anything that comes at it. So managed futures, that's essentially what you could basically call trend following. They are ETFs and mutual funds, and they utilize the global futures market. They could be trading sugar, gold, currencies, interest rates, any number of futures markets. They go long and short too, which makes them highly non-correlated to long-only stock portfolio. So that's what makes them really great. And you can see I'm using this PQTIX, which is just a PIMCO managed futures. That's a mutual fund. And so I just paired it with this 60/40 just to show you how adding this one diversifier really does a great job of increasing your compound annual growth rate. It lowers your drawdowns. Your worst year is much better at under 20%. And this goes back to 2014 back tested. I'm sure you're probably looking at this. Wait a minute, 60/40 stocks, bonds, and then you're adding 40% managed futures. That's 140%. How is that possible? They'll actually talk about that at the end. There are some new leveraged ETFs. You could refer to those as like generation one leveraged ETFs. There are actually leveraged ETFs out there that are considered generation two leveraged ETFs. I'd like to introduce those to you today. If you want to go to the next slide, Floyd. I wanted to give a brief explanation of why and how this works. Think of a car engine and the pistons. As one piston is pulling in the fuel and air, it moves up, hits the spark plug, right? The spark plug ignites, shoots that piston down, right? While other pistons are moving in different order with the engine, and that's how the engine moves, right? And your car goes down the road. That's essentially what we're doing here with the portfolio. So all of these assets are essentially moving to their own rhythm and are mitigating a lot of the drawdown that happens with a long only stock bond portfolio. So if you go to the next slide, Floyd. Yeah, these are a couple of pages out of that all weather book from Tom Basso. These are some pretty cool concepts actually, and made things a lot clearer for me. One of the things he talked about is called filling the potholes. It's looking back at your equity curve and trying to figure out, where am I deficient? And is there a non-correlated asset that I can add into my portfolio that will fill that pothole and make my equity curve smoother over time? It's a neat concept to think about. And I think this could even apply into your canceling trading as well, right? If you're mindful of your equity curve, maybe you develop some type of hedging strategy or some other strategy that would encompass when we get a ton of distribution days. Maybe there's some kind of trigger point, a rule that you make, and that would fill those potholes in your equity curve. So it's just something to keep in mind. The other thing, I know everyone has seen this, right? The drawdown required recovery percentages, right? As you lose 10%, it takes 11% to recover. If you lose 20%, it takes 25% to recover. But this is definitely something to keep in mind as we move forward in the presentation. Go to the next slide, Floyd. Okay, these were my goals. I wanted to use leveraged ETFs, the ones we're all familiar with, TQQQ and UPRO. I did a bunch of research to figure out what are the best leveraged ETFs that I could put in this portfolio and how am I going to tame those ETFs, right? I just showed you earlier how in a market downturn, they're basically dropping 92%, right? 96%. So how am I going to tame this bucking bronco that's a leveraged ETF with other ETFs to try to make something that's a portfolio that I can live with and sleep at night? And even when the sky is falling, I'm not going to change my strategy and I can sleep well and have a lot less stress over time. That was the goal, right? So it's basically utilizing non-correlated stocks and ETFs to diversify that portfolio. Then I have to come up with something that gives me some crisis alpha, right? It's like when, everything's hitting the fan, what am I going to do to make sure that my portfolio is weathered and ready to withstand anything the market can throw at it? I did a ton of research on that, and you'll see that here. I wanted to make sure I had at least 5 non-correlating assets, at least, just to make sure that I have maximum diversification for that risk mitigation. Okay, go to the next slide. All right, this is the portfolio that I came up with. You can see all the allocations. I'll go into it one by one, why I came up with those. So the way this works is I'm using 3 of these leveraged ETFs, UPRO, CURE, and TQQQ. And my notational value is now 75% for equities, but I'm only using 25% of my entire portfolio because since those are 3X, right? So my notational value is 75%, but I'm only using 25%. That gives me 75% of space for other non-correlated assets. I've got gold royalty stocks, coin, Ethereum, anti-beta, BTOL, and some managed futures. I've got 3 ETFs that are managed futures. They're all very different. So I end up with a total exposure of 165%. I'm not actually at 100% on my exposure. It's actually at 165%. So go to the next slide, Floyd. So how has this performed? Starting in 2016, if you had started with $10,000, adding 0 money along the way, your final total would have been $88,288. That's a 32% compound annual growth rate. And my maximum drawdown was only 17.5%. My whole thesis was if I can stay below 20% or even 18, I can sleep well at night. I know the sky's not falling on me based on that law of recovery. I can recover from a 17% drawdown very easily. This is rebalanced quarterly. So you can see over to the right, I've got 75% stocks, 50% is in the managed futures, anti-beta. I did maintain the 60-40, but I replaced bonds with managed futures and anti-beta. Those are my crisis alpha aspects of my portfolio. In my research, I found that over the past 40 years, bonds were not correlated with stocks, but before that, they were heavily correlated with stocks and are starting to be more correlated with stocks even today. Rather than deal with bonds completely, I figure I'll stick with managed futures. Managed futures use rules-based investing. and can even invest in treasuries if they see that's triggering a rule to advocate for trend following. So I'm actually including bonds, but I'm using these managed futures ETFs. They're more like chameleon type ETF where they can change and mold based on whatever the market's throwing at it at that present time. So then I also have gold at a notational value of about 30%. That's my kind of stagflation, inflation diversifier. And then I also have 10% in coin and Ethereum. One disclaimer here, I just wanted to point out these 3 ETFs that are the managed futures, I had to replace those to do my back testing with 2 other managed futures funds that are very similar. That's the only difference on this simulated back test. I had to replace those just to get a longer history. But when I did look at the new ETFs, and I'll show later the current year how these are performing, they're essentially performing the same way that I would expect that these others are performing. So I didn't see any change in that. And then I also removed this ticker symbol, which is part of the gold royalty. That was like 3% of that because I didn't have enough data. I think it went back to 2018. So I'll talk about that in a minute. Yeah, Frank, I'll talk about the gold piece of it. I'll go in depth on each of these. But I did want to point out in the lower right, you can see all the correlations down in that lower right. And you can see everything that's red, orange, yellow is just not correlated at all. And everything works in tandem. So you can see if you look at gold versus TQQQ and UPRO and CURE, it's under that 50%. That's exactly what I wanted. My managed futures, they're all highly uncorrelated with everything. Coin is uncorrelated with managed futures. It's uncorrelated with gold. They're all uncorrelated with one another. Each one is firing at a different time to mitigate drawdown. It's exactly what I wanted. So if you hit the spacebar there, Floyd, I think I've got some boxes that'll fly in here. Yeah. One thing I wanted to point out here, I don't want this to go unnoticed. If you look at this drawdown, this is amazing. Take a look here. This one on the bottom, this Vanguard Balanced Index, that is a 1x SPY, like TLT. Essentially, it's like trading. It's what if you went into like your financial advisor, right? And they wanted to put you in this conservative thing, they would put you in that. Look at the drawdown. I am beating the drawdown of a 1x SPY TLT mix portfolio. And I'm using leveraged ETFs. It's pretty amazing. Look at the worst year from 2016 to present day. The worst year was down a little over 11% versus a 1x SPY TLT down almost 17%. This is proof that adding a bunch of diversifiers in a portfolio like this, you can really mitigate your drawdown and sleep better at night, knowing that you've got this diversified portfolio working for you. Okay, so go to the next slide, Floyd. This was a slide I put together last time. If you look at the declines, I did a bunch of research looking at TQQQ and QQQ, and if QQQ was actually moving at 3x, what would that actually be on the decline? And you can see all of the declines in its history are actually better than the advertised 3x. And then if you look at the advances, almost all of the advances outside of the 2015 advance, which was a flash crash, it was down 16%, but all of those advances were more than what a 3x QQQ should have been. So you can see, just take the first one, right? QQQ advanced 148%, but TQQQ advanced 1,036. 1,036 is not 3 times 148%, something that we can obviously take advantage of if we use it correctly. This is a huge advantage for us, right? These leveraged ETFs, because they're giving us more than 3x on the upside and less than 3x on the downside. So it's just very interesting. I just want to make sure that everyone's aware of this, that these ETFs are actually quite advantageous for us to be trading. I explained this in the last one as well. You can see on the advances down below, if you jump up 5% each day on QQQ, your advance is 22%, but on TQQQ, it actually is 75%, but should have really been 66% if it was like a 3X, but they're not acting that way, right? Because they reset every day. So the 3X is really on the day only. So you get a lot of wind at your back if you get these massive uptrends. And if you can stay in those over time, that's how you get these outsized returns. So that's the key, right? If you can stay in it and you have something to mitigate that drawdown, there's no reason why you can't stay in it. You can take advantage of all of these uptrends over time, and your declines are going to be a lot less as well. So go to the next slide, Floyd. Okay, so let's jump into this. I will go through each of the items, the equities, gold, all of that.
Elliot, are you okay with when I send out the meeting recording, if I send out a PDF of your slides?
Absolutely. Go ahead. All right.
Yeah, it looks very interesting.
Thanks. Okay, so let me just jump in here. Let's talk about the equity sleeve. So you've got UPRO, that's a 9% allocation, CURE is 12%, and TQQQ is 4%. I'm not going to talk about UPRO and TQQQ. Everyone here is familiar with those, but I'm sure everyone's asking, why are you investing in CURE, which is the healthcare ETF? Very interesting. I looked at the XLV, which is the healthcare ETF. It's essentially what CURE is based on. CURE is like 3X of the XLV. Downturns in the market. You've got COVID in 2020 and 2018 bear and the 2008 great financial crisis, 2000.com, right? So I've got XLV compared to SPY. In 2020, you can see the black line doesn't fall nearly as much as SPY and actually recovers a lot faster than SPY. 2018 saw the same thing, not nearly as bad, right? 2008, great financial crisis, it fell, but not nearly as bad as the SPY and came back right away. And then look at the .com bust. That's XLV versus the QQQ. It's like XLV just yawned and didn't even blink an eye about it, right? And if you look at XLV, I actually compared XLV versus SPY versus QQQ, 2000 to present day, 23 years of data. And you can see how XLV is just crushed the SPY and the QQQ. So I overweighted to CURE because I felt that this gave me a diversifier. The correlation, I think, is like 61%. Right? It doesn't show up as a under 50% non-correlated asset, but I felt like in my research, this was a good ETF to have because in those times of crisis, people still need to see the doctor. People still need to have their blood pressure medicine or whatever it is. That's not going to stop even in a downturn in the market. So that is the equity sleeve makeup. If you want to go to the next slide, Floyd. All right. Let's talk about gold. The allocations I have here are what WPM is 4%, FNV is 4%, RGLD 4%, and then OR, which doesn't have as much history as the other three at 3%. So you get 15% for the gold royalty stocks. And you're probably wondering, why in the world did you use gold royalty stocks? There is a 2X GLD, which is UGL. And you can see down on the lower right where I actually did a back test here on these 4 royalty stocks versus the 2X gold, right? UGL. And the gold royalty just blew that away. It actually acted like a 3X ETF having these stocks in there. There's a lot of history with these stocks. They essentially make money by purchasing a portion of the future production of gold mines in exchange for upfront payments and ongoing royalties. That allows the mining companies to secure financing and giving royalty companies a stake in the potential profits of the mines, benefit from both rising and falling gold prices. In a bull market, the value of their royalty stakes increases. In a bear market, they still receive a percentage of the gold production. So that provides some stability to their income. So again, this is another diversifier in my mind, right? So even in a bad market, these stocks are not going to fall nearly as much as potentially the gold price itself. And that kind of bears it out by just looking at the back test. And then I did put the correlations here. You can see how these are completely uncorrelated with all of the other pieces of the portfolio. All right. So let's talk about Bitcoin. When I was looking at this, I was, again, trying to find assets that are highly uncorrelated with everything else and have a track record of outperforming, and Coin is certainly one of them. This was something that Charlie Bailio had it on Twitter. I lifted that and put that in here, giving him credit. You can see Bitcoin is the best performing asset. I believe it still is. Nothing's even close. You can see 230% annualized. That's just insane, right? If you're unaware of Bitcoin, it's all over the news. Basically, it's a peer-to-peer network. All the transactions are being recorded on what's called a blockchain. Anyone can see those transactions. There are nodes out there that confirm transactions. What I did in my back testing, I was trying to figure out, how do I trade this? There is this GBTC Bitcoin ETF, and I know that there's some stuff going through the courts. They're trying to get ETF status, and they did get the favorable ruling. The SEC may or may not allow it to come to fruition. When I was doing my back testing, I found that MicroStrategy was a better proxy than GBTC. You can see that with the orange line. It followed Bitcoin quite well. The other thing I like about MicroStrategy is that there's an underlying company to that, right? They have earnings, they have sales, there's a management company there. Whether you like Michael Saylor or not, he's definitely a polarizing figure. There's value behind the company, aside from the fact that they own 158,000 Bitcoin, right, on their balance sheet. So I found that this was a better way to play Bitcoin, at least for the time being. Ethereum is another one that I added. I added only 3% of Ethereum. This one is much more volatile than Bitcoin. It's more in its infancy. Actually, it's getting more widely known now. It's definitely not on the same level as Bitcoin. It started in 2015, but essentially this one is a open source blockchain, but it focuses in on smart contracts and decentralized applications. The only real way that I found with this ETHE at this point, so this was the ETF that I went with, the correlations in the lower, if you look at the correlation between Bitcoin and Ethereum, it's actually under 50% between the two. Those two are not highly correlated over time. I found that quite interesting in my research. So let's talk about managed futures. This is the section of the portfolio that's my crisis alpha. When everything's getting completely taken out of the woodshed, this is where these managed futures should come in and save the day, right? So they're essentially rules-based, systematic returns. Managed futures are investment funds that invest in futures contracts with other derivative instruments across various asset classes, such as commodities, currencies, interest rates, and equities. I actually found this slide in one of the mutual funds slide deck. They went back and looked at trend following all the way back to 1893. And you can see how 60-40 stocks and bonds compared to trend following. And it's not even close. Look at the green bars there that are mitigating a lot of that downturn, right? Amazing. This can hold you in the event of a crash or something going on, right? And then if you look at the correlations on the right, highly negatively correlated there with our equity section with the TQQ and UPRO and CURE. Go to the next slide. I did my own study. I went back to 2008 and I was like, okay, this is great. Let me see this firsthand. I want to make sure that this is really what's going to happen. So I recreated my portfolio, but I couldn't add Bitcoin. I couldn't add Ethereum because they just didn't exist at the time, right? So it's impossible. So I did add leveraged equities. I added my managed futures, although I did add more managed futures because I'll show in a minute that BTOL, an anti-beta ETF, didn't exist as well and is much more crisis alpha than managed futures. I'll show you that in a minute. So that kind of adds in essentially a proxy for what BTOL would have been. And then I added in gold as well. You can see that blue line there, right? That is my simulated portfolio. It made a high in May 2008. Over on the right, you can see what the S&P 500 index looked like at the time. So you can see I point out that first arrow down, that's the May 2008 high, right? That's when my portfolio made a high. Then you can see it pretty much went flat. It didn't get hit much in 2008. And then you can see it made another high in May 2009. Look where May 2009 is, down in that other graph, right? You're down in the doldrums, and here my portfolio is making a new high. It's pretty amazing how it's able to mitigate that downturn. Okay, so here are the managed futures funds that I picked. I picked KMLM. I gave that an 18% weighting, DBMF 12%, and then CTA 8%. I have the correlations right below that between them. You can see it's quite interesting. You've got CTA versus KMLM. That's actually under 50%. And then CTA versus DBMF, that's at 51%. We're right around that kind of, it's correlated, but not really, right? You're at that threshold. So I felt like all three of these had a place within the portfolio itself. So I'll go through each of them. KMLM essentially is global diversification. It trades in 11 commodities, 6 currencies, and 5 global bond markets. And the interesting thing about KMLM is they don't allocate any money to equity markets at all. So it's all commodities, currencies, and global bond markets. DBMF can go both long and short, global equity, bond, commodity, currency, futures. They can also, they're one of the only 3 funds. They're the only one that has exposure to long and short equity indexes. So they can long and short the SPY or the QQQ or that sort of thing. And then CTA, that has 4 distinct long-short managed futures under one wrapper: trend, carry trade, mean reversion, and risk off. So that one's also quite different in its makeup. And then I pulled the one slide over to the right, KMLM. They have a slide on that ETF where they went back and simulated the performance based on the index return for that ETF. And you can see how that would have performed during November 2007, February 2009. As the S&P is down 41%, this is up 37%. I did the same simulation right in the slide before this. I basically came up with the exact same results in my back test. I can definitely vouch for these numbers. In 2022, you can see the performance while everything was falling out of bed. You can see the return for the DBMF, 18%, KMLM was up 21%, and the CTA was up 23%. And from April to October, the biggest part of that drop. And I just wanted to see, do these actually even work in inflationary environments as well? So we know they work in a deflationary environment in 2008. So now I've got proof that they also work in an inflationary environment. Okay, go to the next slide. All right, so this is the last piece of the puzzle of the portfolio. BTOL essentially provides a consistent negative beta exposure to U.S. equity markets. Essentially, it invests in long positions in low beta U.S. equities, so you think like Dow stocks, and short positions in high beta. So those are like those CanSlim stocks that we all trade. So even in an uptrend, it's shorting high beta stocks and buying low beta stocks. In a downtrend, it's doing the same thing. So they're just following the rules-based allocation for this particular ETF. And you can see what this does in COVID 2020. This thing just rocketed up and held steady the whole time. 2022, same thing, wasn't even phased by 2022. So this is a good diversifier to have within the portfolio as additional crisis alpha along with the managed futures. If you can go to the next slide, Floyd. This is the 2023 performance so far. So this is quite interesting that you can see here. I've got the ultimate left portfolio at the top. So far, it's got a 17% return, only a 4% drawdown. Look at the 60/40. This is exactly what I saw in the simulated returns all the way back to 2016 when I did it. You can see 60/40. These are 1x ETFs, 60/40. SPY, TLT, the max drawdown is actually more than the leveraged all-weather portfolio. It's pretty amazing. I'm just so excited about this, that this thing is just performing so remarkably well. You can see over on the right, I've got the monthly returns. You can compare the two. I do have another portfolio. I'll talk about the ultimate 401k. Okay, go to the next slide, Floyd. What would have happened if you had DCA'd into this starting in 2016? Let's say you started with $10,000 and added $2,500 a month. Your final balance would be $730,000. That's a 73, almost 74% compound annual growth rate. Look at that drawdown. Your max drawdown is under 13%. That's going through 2008, that bear market, going through COVID, going through 2022, right? Look at the blue line. It's so steady, right? Yeah, it doesn't really waver. It's on this nice trajectory up, right? You can sleep well at night. You don't have to find your Pepto-Bismol when there's a crash happening. It's truly amazing how this thing works. Go to the next slide. All right. So I did want to talk a little bit about these Gen 1 and Gen 2 leveraged ETFs. This is probably something that you may not have heard of before. These are some new ETFs, so I will warn you that some of them don't have a lot in the way of volume, but that may change over time. It's something that I'm not necessarily interested in at the time. I'm just watching it as maybe these are things that I might want to add in as little puzzle pieces into my portfolio, but I'm not there yet. I think they need to have more history behind them. They're interesting though, for sure, what they're trying to do here. You can see the Gen 1 are the ones we're all familiar with, but Gen 2, what they're doing is they are trying to create these, I guess, full one-stop shop, right? That was kind of the word I was looking for. One-stop shop, like portfolio in a box kind of thing. You can see you take these and they're little puzzle pieces. You can add them together and make your own portfolio out of them. So I got a couple mutual funds as the first two, PSLDX. That's 100% stocks and 100% bonds. So the way they do that is they invest 40% in stocks and then 10% they use futures contracts to make up that last 60%. For the bonds, same thing, right? 40% is in bonds and then 10% is in futures contracts to create this notational value of this 200% mutual fund. The one that is really exciting that I actually have in this ultimate 401k is this BLNDX. I feel like this is the Michael Jordan of managed futures funds. This thing is just amazing. GDE, that's a 90% large cap equity and 90% gold futures. And then you've got these NTSX, NTSI, NTSE, it's 90/60. So those are US, international, and emerging markets. There's two here that are somewhat interesting that they don't have the volume yet. They're very thinly traded. So RSBT is 100% bonds, 100% managed futures. And then RSST is 100% equities, 100% managed futures. Okay, go to the next slide. Okay, so how would you use these? For example, if you wanted to create a portfolio that's a 60/40 stocks bonds, but you wanted to add 40% managed futures, right? This was what I talked about earlier. How do you get to 140%? So this is how you do it, right? You take 60% in SPY, 40% RSBT. So you'd have that 100% bonds, 100% managed futures. So that would get you your bonds and managed futures part of the portfolio. I actually took out that 25% cash that I talked about earlier and swapped it out with managed futures. And so you can get pretty close to that with just this RSBT and GDE. So 50% RSBT, 50% GDE, that would get you about 190% exposure portfolio. So 50% managed futures, 50% bonds, 45% equities, and 45% gold. And you could get complicated too, right? If you wanted to have 60-40 stocks, bonds, 60% managed futures, 15% gold, and then 15% of that anti-beta, you could do that. Okay, go to the next slide. This BLNDX fund. So I came up with this allocation, 95% BLNDX and then 5% MicroStrategy for that Bitcoin piece that BLNDX is not going to provide. But BLNDX is quite interesting because it's 100% managed futures, but they can go long and short domestic and international equities. So you can see all the markets. It's 75 markets, so it's much more than the ETFs that I talked about earlier. And you can see the return of this thing. It's amazing. Since 2020, it's up nearly 15%, and the drawdown is about 8%. I found this quite interesting. I'm actually using this in my 401k and have been for several months now, and it's pretty nice. All right, so this is how I manage currently. This is how I manage the ultimate all-weather portfolio. I use M1. They use these things called pies, and you can designate your slices in the pies as the percentage that you want to allocate to each ETF. And so that's essentially how I've set it up. Those percentages don't change. As I add new funds, it smartly allocates the funds. If I'm short in one ETF, maybe it's down over the past month, it will add more funds into that ETF to bring me up automatically to the percentage that I need. I don't have to get out my Excel spreadsheet to figure out how to allocate my money. It just does it all automatically. I put the allocation over on the right. There's a link to invest in the pie if you want it. You can click there or use the allocations that I have. I think that's it. If you want to go to the next slide, Floyd. Yep. All right. What questions do you have?
I have a question.
Sure.
This is George in LA. I'm looking at the lifetime of TQQQ. And despite 2022 being a bad year, despite the COVID crash, it's still up almost over 9,000%. This year, it's up over 135%. Why not just buy and hold it? You'll have the drawdowns, but it'll bounce back.
Yeah, you can certainly do that.
Are you not hesitant to do that because you want to sleep better?
Yeah, exactly. I don't like seeing my account drop by 90%. I simulated that. We haven't really gone through anything like that in 2008 or 2000, but that's exactly what would happen to TQQQ. So if you don't mind seeing your 100,000 drop to $8,000, then that's just not my cup of tea. M1 is a broker, but they do things a bit different. So it's based on these things called pies and percentages. And so you just simply allocate the percentage. You can set up your portfolio based on those percentages. It's really the easiest way that I found to manage this. You could certainly do this through your broker, like Interactive Brokers or Fidelity or whatever broker you use, right? You could do it that way. It would probably be a little bit of math involved because as you're adding funds, you have to designate, okay, I need to buy this many shares of KMLM and I need to buy this many shares of UPRO or whatever it is. You'd have to have a spreadsheet that would tell you that, which wouldn't be hard to make.
And what kind of fees do they have?
They don't have any fees.
So basically, one is a dollar cost average, 5,000 a month. You just do that and they automatically split it up in the pie.
Correct. Yeah, correct. So it'll look at your percentages and then it will just allocate it to make sure that it maintains those percentages that you've set up in the beginning.
Okay, I see. Thank you.
Yeah, I currently have my Roth in there and have that allocated to this. I dollar cost average into that every month. I put 2,000 of the account in that until I get up to my main amount in a year and a half. But yeah, that's what I'm doing.
For the presentation.
Any other questions out there?
Hey, Eric, this is Yogesh. Thanks for helping us understand what is managed futures ETFs. I was aware
Yeah,
of
of
the
course.
concept, but really helps me to see it in action. A couple of questions. Now, most of your portfolio has ETFs except for gold, royalties, and Ethereum and Bitcoin. You're using MicroStrategy as a proxy for it. So have you considered that since especially MicroStrategy and the gold companies, there is a chance that things can mess up and they can go bust or things can happen. So how are you going to counter that risk?
That's why I have 4 of them, right? And they're a very small percent of the account, but they also they've been around forever. I think WPM, I mean, that's like a 20-year-old company or more.
Even ExxonMobil, big companies are here for a long time, but they can go really bad.
They could. Yeah, they could. You're right.
So at what point do you watch those companies, or like how would you, like, for example, let's say OR is not performing well or something is going bad. Do you track it every month?
I try to keep track of news, see what's going on. I try to pick established companies that have a longer track record. Again, I think they go back to 2016. So they're the baby of the group. So I didn't allocate as much to them. It's only 3%. The other 3 are much more established companies.
So wouldn't it help we just go with gold miners like GDX?
Yeah, you could.
I think the main thing is develop what you're comfortable with, do your own back testing.
I think this is a launching point, right? I think Floyd brought this up in one of the meetings. We're all here to help each other, right? I'm not asking for any money for this. You don't have to trade it either. I'm just presenting it to you and you may find a better method, right? Hopefully you can take this and then make your own and then it performs even better than the one I've got.
And if it's better, let us know. Anybody else out there?
Anything else?
Thank you so much, Eric. Fantastic. I'll make a PDF of the slides, and when I send out the link to the recording, I'll send a link out to the slides. I think maybe stop sharing there if you're sharing, Eric. Let me see if I can bring.
Yeah, I think you were sharing, Floyd.
Oh, yeah, I was. Hey, okay. Can you guys see my Thinkorswim chart? Okay, so let me minimize it and try to do that again. Let me see, share. And go like this. Can you see, can you see Thinkorswim now?
Yes.
Okay, so this is a Thinkorswim weekly chart. And I have SOXL. And from last month's presentation for SOXL, we go with this full stochastics of 533 rather than the Market Smith style stochastics. But I'm just showing it to show that we're clearly in the buy zone for SOXL. Let's put up TQQQ. And this is through today's closing prices. See TQQ, we use the Market Smith style stochastics with a period of 533. Notice that we're clearly in a buy zone on TQQ. I've also briefly looked at the TECL, which is pretty close to SOXL. It's a tech bull times 3. You can see we're clearly in a buy zone. And so even though today was a little bit challenging, it's still been a very good week. If you're following the strategy that Rick and I presented last month, we talked about using a weekly chart and using the 2 different styles of stochastics depending on which ETF we're in. I don't know if people are watching this with the stochastics or not, but we come up with a strategy that tells you when to buy and when to sell. I haven't updated the markups on TQQ, so I don't have the last 2 buys and sells. If you can see back through the beginning of the year, we've got a buy and a sell and a buy, sell, etc. I marked these on here. I just haven't shown the last 2. I don't remember the time frame now. It was on last month's presentation, but I think in 2023, we were in cash maybe 40% of the time. And it wasn't a fantastic return, but it helped protect us from the downside. I'm just going to leave it at that and see if anyone has any questions for me or Rick about the leveraged ETFs and our strategy using stochastics before we sign off for tonight.
Hey Floyd, just to double check I'm understanding this correctly. The buy signal came last Friday, right?
The buy signal came last Friday on SOXL. Let me bring that up. SOXL. Last Friday was this mark right here. You'll notice that no matter which stochastics you're using for SOXL, we typically go for the lower stochastics, the fall stochastics. You can see the fast line is above the slow line on last Friday. If we look at TQQQ, an interesting thing happened last Friday. If we look right here, it said the fast line was 24 and the slow line was 25. About an hour before the market closed, they were exactly the same number. It was either 24 or 25. This is as close as you could get and not be exactly the same. But then you'll notice Monday it jumped. They added a mark I didn't want to add. Last Monday, we were clearly ahead. So if you bought last Friday, even though we're supposed to either be tied or one number higher, we were so close that it was, to me, it was close enough. If you bought last Friday, you're pretty happy with the performance. Did I answer the question?
Yeah, perfectly. The difference between the two stochastics is the stochastic above is the 533 that we're using for TQQQ. And what's the one below it?
It is the fall stochastics that doesn't truncate the numbers. The Market Smith stochastics takes the fast or the slow number, and let's say the number is 29.9, it displays it as 29. It rounds everything down to be an even whole number. The full stochastics don't do that. And I don't know, Rick, if there's any other nuances and differences between fall and Marcus Smith other than the truncating. Is there anything else that's different?
No, that's really it. It truncates the numbers after calculating the EMAs, and then the formula includes adding the two numbers together. It just makes them whole numbers. You can see there's actually very little difference between the two, except that the Market Smith one runs slightly lower than the stochastics full, which is Thinkorswim's version of the stochastic. Yeah, it's just standard stochastic. But we're using exactly the same settings with the 533 and the EMA. You can quickly overlay these two and see how closely they match. The fast lines are practically identical. You want to give that a try?
How do I do that?
Go to the beaker icon. This is where we set up. Drag stochastics full into the same group with stochastic Market Smith. Just drag it up so it's in the same box. Yep, drop it there. Zip, they're both in the same box. Hit OK. It'll apply. So it puts them both now in the same box. And you can see
the orange and the pink fall.
Yeah, but basically those lower two. The problem with doing this, though, it's so strange. Even though they don't, there's something weird about Thinkorswim. Thinkorswim doesn't overlay them on exactly the same scale. And so you see those blue lines, they don't match. You can make them exactly the same number.
Hey, we're getting rid of this, buddy, right now. I don't like that.
It wasn't a good demonstration there. I forgot about that.
Wait a minute, that didn't work.
Literally, Thinkorswim is not putting them on the same scale, even though it looks like it is.
So do I just drag it down?
To that lower, yeah, to right there. Yep, there you go. Just hit OK. And then you'll be back to where you were.
The part that surprised me when Rick's backtest model is so powerful, and I think it's got 200 and some thousand equations in it. When I was looking at TQQQ using the standard full stochastics, We get a number. Let's say at the end of the period, it would make $150,000. Then I would change to the Market Smith style stochastics. For TQQ, every time I did that, I'd make maybe 10% more money than if I was using the full stochastic. It surprised me, even though the graphs look almost exactly the same. When you use an actual computer model and maybe 100 trades, there's just enough difference that for some reason for TQQ, it performs better when we use the Market Smith style stochastics. And when we do SOXL, it performs better if we use the full stochastics. Someone would have to go through each of the individual trades to figure out what's going on, but I'm just sharing with you that a surprise of all of I probably have done 1,000 back tests now that Rick's got his model going very well, and probably more than 1,000 of them. And I've done a lot of what if trials. I can change one variable in maybe 2 seconds. In an hour, I can do dozens of back tests. That's when I discovered that TQQ performs better if we're making our decisions based on this Market Smith style. I can't exactly tell you why. I'm just sharing what the model told us.
I see so little difference between the two. Floyd said he's talking about like 10% difference over a 10-year back test. To me, it's almost random because I don't see any particular advantage to that Market Smith formula. It was just to truncate these numbers before they add them together and plot the numbers. It almost strikes me as something they did to make the plotting equations easier, to round them off to whole numbers.
I think that's an excellent point, Rick. In either case, if you have smart buy and sell rules, you'll make money whether you use the full stochastics or the Market Smith stochastics. I'm just sharing with you what I learned back testing. We're looking backwards. It doesn't necessarily mean it will be true in the future.
Yeah. And Floyd, he's done just a ton of these tests. So there's no question about it. We're reinvesting all the proceeds from the first trade into the second trade, and then the second trade into the third, all the way through for 10 years. It's just that one little difference along the way, especially near the end, can get you a 10% difference because these are all being multiplied. All the gains and losses are being multiplied against each other. That's a way we won't be able to calculate it.
In the real world would trade at all. We wanted to use a common benchmark between the two. When you actually do deal trading, there are psychology, we got other investments you're in, we have taxes to consider, we have the wash sale rule if you're in a taxable account. And so there's other things going on. And so we don't want to imply that if you take $10,000 and wait 10 years, we're not wanting you to think these guys told me I'm going to have 250,000 or 500,000 in 10 years, because that is not what we are telling you.
Floyd, you just made a real good point about that wash sale rule. If you're doing this in a taxable account, that could really hit you bad if you're reinvesting in the same ETF time after time. So you got to watch out for that. The other thing I found interesting is that the way Thinkorswim does back testing, it doesn't reinvest for each trade. It doesn't take the total from each trade and then reinvest that in the next one. By default, it invests the same amount over and over again, however you want. So its results are additive. It adds together the results of its trades to give you a total, as opposed to what we're doing, which is reinvesting them. If you do 5 trades and they make 10% each, with the TOS default model, you're going to add those 10% together. You know, I had $10,000, I made 10%, and I still invested $10,000. The second time I made another 10%, invested $10,000. The third time made another 10%, and you add those together to get your total. It's additive. What we're doing is multiplicative. We make 10% on the first trade, then we're investing all that 110% in the second trade, which gets us 121%. If it's 10%, we're investing the 121% in the third trade. It multiplies them. And so what it occurs to me is that the difference between those, the effect of the way we're doing it with the multiplying, is at the end of the trade, the trades that are most recent, the ones that are the ones that are the most recent are going to be way more powerful on your total account value than the older ones. Because now if you're making 10% this year, you're making 10% on a much larger number than if you're still investing $10,000 every time. It magnifies the most recent trades.
That's like a 401k. If you're putting money in every month for 30 years, when you get near retirement, the performance of the market in that last year is critically important to your total account value when you retire.
Yeah, exactly.
We just want to make sure that everyone understands that we've taken one approach. We want to be 100% transparent on the approach, and that each person then, when they go to implement it, we could give every single person on this call $10,000 and say, go implement this strategy the best you possibly can and come back in 5 years. In 5 years, we would have 48 different total values because none of us would do it the same.
And Floyd and Rick, from the last session, I remember you guys saying that you only buy or sell on a Friday. Is that consistent with my understanding?
We have stop loss rules. And so if the stop loss rule kicks in on a Monday or a Tuesday or a Wednesday, then you're not waiting till Friday to sell.
But the buys will always be on Friday because that's when the weekly chart is updated.
Rick, I've gone through the spreadsheet and there's more than one case where if we got stopped out on a Monday, if the fast line is higher than the slow line, the model actually has us rebuy on the next day, like on a Tuesday.
That's the exception.
But if the stochastic is below 37, which is the overbought area, and the fast line goes below the slow line, you wait until Friday for that?
Oftentimes, one of the stop losses will jump in and sell it before you get to Friday. But if one of the stop losses don't kick in, these lines in the model, these lines only adjust on Friday. So you wait until Friday. If there's a cross on the way down, like here, it's crossed, but we have to wait until the fast line gets down below this overbought line. That's typically on a Friday.
Because if we got in or out before, that'd be a little bit of a cheat. In fact, I've done it before myself, but we don't do that for the back testing. What Floyd's saying, if we were to take out all the stop loss rules, we would just be trading on the Fridays because that's the end of the week, because we're doing it based on the weekly chart.
You would sell here, you would buy there, you would sell here, you would buy there if we didn't have our stop loss rules. If you can see my cursor.
Yeah.
Here's the fast line goes down. If this is our decision line, if that's a Friday, you sell there and then you wait all the way over to here. We crossed here and that's above this oversold line. If that's a Friday, then you would buy back right here.
It's simply just because we're using weekly charts. We did a lot of back testing and didn't find that it gave the same performance as the weekly. So, although I preferred using the daily one.
You would have a ton of trades.
Right.
My personality is if you give me 100 trades to do in the next 10 months, I'll probably screw it up. If you give me 10 trades to do in the next 10 months, I probably can handle that.
Floyd, I had a question. Where your pencil is pointing, it looks like a sell and a buy on the same week. Am I reading that right?
You to the right?
Yeah, right there. What is that? It looks like a sell and a buy in the same week.
You can look, when he has his cursor there, you can look over to the left and see the actual values. So are you looking at the bottom one or the top one?
Because TQQ is the bottom one because I messed them up when I moved them over. The fast line is 39 and the slow line is 41.
Yeah. So basically what it did is the week before the fast line was above, that week it dipped below, and then the next line, the fast is above.
To answer the question, I have to go to the spreadsheet, but I put these in visually. So it was my eyeball where it goes. If we looked at the spreadsheet, this may be one of those cases where there was a buy in the middle of the week And then stop loss kicked down a day or two later. It kicked us out.
I think that's the case.
See how deep this bar is? So it opened here and closed all the way down here. In the beginning of the week, we probably had a buy signal. And then by the end of the week, we probably got stopped out and sold either Thursday or Friday. But if we look at the actual trade dates, it would be more obvious. These are just my eyeball of where I thought they were.
Again, because of the trading, we could be buying and selling on individual days, and then he's reflecting that on a weekly chart. Yeah, in fact, I would guess the sequence is there that first you see that buy 2 weeks before, and then it would be a sell and a buy that week, because you see we're long, and then because the next one, 5 weeks later, is another sell. So it must go buy, sell, buy. And then
Yeah,
sell.
so if there's a buy here, the sell had to come prior to that buy.
Yeah, exactly. But the crossing of the stochastic wouldn't cause, if what you were asking was, would the crossing of the fast and slow line stochastics cause a buy and a sell in 1 week? No, that wouldn't happen. It has to be because of the stop losses, because that would just be a sell that week, buy back the next week if you were just going by the crossovers.
That's what I was confused on. It looked like you were in the trade and then you had to have sold. I didn't really understand why you would buy it back. It doesn't look like you're all that far from the bottom of that bar for the week.
That's where his annotations of this chart don't show enough detail to answer a detailed question like that.
What's the date?
And
31/22.
basically the bottom of the market.
10/31/22. Let me see if I can bring up a spreadsheet and show you exactly what the dates are. Just give me a second.
Lloyd's going to do this live, so we're living dangerously here. Never know what can go wrong with Excel spreadsheets.
Let me see if we can get an answer here. Can you see my screen?
Yep.
Okay, let me go to trades. That was 10/31.
The week of. So it's that cell right there, 11/2, because that's the middle. Because in Thinkorswim, when it gives you the weeks, that's the Monday. So there you go. You have a sell on Wednesday and a buyback on Thursday.
So it's this one right here then, right?
Yeah.
Okay, so see that? We had a stop during the day. That's our trailing stop hit in. Apparently the fast line was higher than the slow line. So we bought back the next day and it resulted in us making a 15% profit. We bought it the next day and held it until 12:15 and made 15%. The main thing that frustrates Rick and I about the model we have is the size of the drawdown. We're trying to figure out what to do about that. We've got 40 different things bouncing off the walls and limited capacity for time availability. But this particular test was for 4.7 years. Our first trade started on December 31st of 2018 and went through yesterday. We ended up with $112,610. And buy and hold was $41,000, I think. It's better, but it's not shockingly better. This is TQQ buy and hold. This is the performance chart with the blue bar being our strategy, and the gray bar is if you just did a buy and hold. You start with 10,000 and you ended up with about 40,000 with buy and hold. And we've got like 120 or 30,000 here. But notice all these flat areas are when we're in cash. This thing got as high as 160,000. We could do better, and we haven't quite figured that out just yet. And a strategy where we invest in SQQ. Instead of going to cash, we go to SQQ. Notice we have $112,000.
We have not mastered this yet.
Do I have to hit refresh?
No, you shouldn't. I don't know why it's, hit F9 for in case it's not recalculating. Wow, Floyd, I just saw your weather. It's 36 degrees, rain and snow. It's not like that down here in Houston. Did you hit F9? I would expect it to calculate right away too.
Hit refresh. We had 112,000. So we put the inverse in.
You have to go yes, capital Y, small e, small s. That's what it is.
Y-E-S. We ended up with $27,000, 27,000. We always thought putting in the SQQ would, like, we called it our turbocharger, and it's not a turbocharger. So we are real frustrated right now, and that 112,000, we do much better if we don't put the SQQ on. And so we've got a lot of homework to do yet, guys.
We know it can be done. We just got to figure out a good formula.
But the nice thing about it is, without the SQQ, notice we only had 24 round trip trades in about 5 years. That's pretty sweet. This linear chart represents the 24 trades. I can do 24 trades in 5 years, and I'm happy if I got 112,000 if I started with 10. But we think we can do better.
At 50% drawdown, it would be hard for me to hold on through. Floyd is a lot better at that than I am.
And Floyd and Rick, and I appreciate all the guidance and research behind the strategy. I think it's way less prone to error compared to the daily weekly. What was your thought process of changing your strategy from the daily weekly strategy you presented last year to this strategy you presented last September?
Honestly, for me, it was because it was a lot easier to code in the Excel spreadsheet. This was just the first step, either to do just the daily or just the weekly. That's what got us this far. And then we saw good results. Just hadn't gotten to the point of trying to code it daily and weekly in one spreadsheet.
And let me share something with you guys real quickly. It's getting late, but can you see Thinkorswim?
Yep. Yeah, we see it.
So here's my vision. If we stick with the weekly chart only, see this fast line, how it goes flat and just slightly up right there? See that?
Yep.
My thought is this might be relatively easy to program. If we use our current model, we wait until the fast line crosses. If we want to try to simulate the old daily weekly strategy, all we have to do is buy right there. And we would buy at a lower price than if we wait until it crosses over here. We might buy and then it turns lower. So we have to sell at a loss. It isn't always better, but I see these examples where if we can program it so that if on the weekly chart, the fast line goes flat or up, we buy early. We haven't been able to do that yet. It would be interesting to see if that gives better results. We stuck with the weekly chart and we have a wish list of things we're considering adding in the future.
And also the drawdowns are way less with this strategy as compared to the last strategy because we were using 10-3-3 or something, or 14-3-3 or whatever it was.
The Market Smith stochastics don't work with leveraged ETFs. The leveraged ETFs just move too darn fast. And I think I told you last month, I talked to two different people. I talked to Amy Smith, and then Amy got me in touch with a very senior manager in Market Smith. And I laid out 2 or 3 what I thought were very important changes that need to be made. And the guy was taking notes. And they got a committee and they put it under consideration, but he made no promises. But I said, if people are paying more than $1,000 a year and you got a stochastics tool here that should be relatively easy to let us program in the period, because right now it's 14. I said, we'd like to make that something different, just like you let us change the period for the moving averages. That conversation was quite a few months ago. I have no idea if it's going to happen, but since it hasn't happened yet, it forced me to go over to Thinkorswim.
Yeah, and that 14.55 just moves way too slow for leverage ETF, so the drawdown could be way more. At least the 5.33 moves pretty quickly.
Not only the drawdowns more, you don't make near as much money on the upside either because you're getting in too late, you're getting out too late.
That's true, but with the daily weekly, we're using the daily to get in.
We look at the daily chart to see when the fast line crosses up through the slow line. But then you immediately go over to the weekly chart and you can't buy until the weekly fast line stops going down. So that's why I was thinking if we just looked at these cases like here that I'm circling with my cursor or over here, if this fast line has gone up slightly on the daily chart, it's already passed through. And so I don't even think we have to look at the daily chart. We just look at any case where the fast line goes flat or up. That would be an early buy signal. And so we just haven't programmed that yet.
Hey, Floyd, this is Gilmish. Did you get a chance to look at some of the modifications I mentioned?
Did you see any modifications?
Essentially,
I saw you just sent a couple of emails, but honestly, I am way behind on emails. I remember that you sent them, but we haven't even been able to try out the things that Floyd and I wanted to do, let alone try.
so what I saw in Floyd, your model is, especially when there is an uptrend, because of the way the sell signal is structured, you have to get out when it is triggered, even though we are in an uptrend. Versus, so I actually tweaked a little bit of your sell signal, and it keeps you in the trend when you are in an uptrend. So that kind of reduces your number of round trips.
Have you done any back testing on it?
Oh,
And your strategy?
yeah. So I'm in the process of writing it. It's still not complete script. Right now, as you can see, Floyd has mentioned buy and sell signals, right? So in Think or Swim, you can code it in the indicator in such a way that it will change the color of the price bars when you want to buy. So I changed them to green. In my email, I included those graphs. You see those green bars. That is a clear visual indication for me to see when the buy signal has triggered and when the sell signal has triggered. So I don't have to write them out. And what I also modified the script further, the indicator that you have at the bottom, which is a weekly indicator, you can plot the weekly indicator on a daily chart. But my goals were, I had two goals. One, when there is a trend, I don't want to get out. I want to stay in. With your current model, it takes me out because of the sell signals you have. So that's why I tweaked it a little bit. The second was getting false entry signals. At the beginning of this slide, you can see here, the first buy signal is a false signal because immediately you have to sell. And you will see there are a bunch of them in there, especially this happens during a bear market or a correction. So my second intent was, okay, how can I avoid those signals? Even though I'm getting a buy signal, I know this is not going to work. I'm still trying to figure it out. That's the reason I had done it on a daily chart. So I see the exact same you have on a weekly, but plotted it on a daily, but the indicator below is still weekly on the daily chart.
Keep sharing with us because we are open and would love anything that people want to share and help us improve the strategy. We've been getting a blizzard of emails and maybe a little bit behind, but we welcome them honestly.
Yeah.
And the other thing,
What is your last name?
oh, sorry, KASAR. You may not find it in my email.
Okay, you sent us an email or no?
So the other thing I wanted to mention is this not only works on TQQQ, this also works on all other ETFs as well. Because I have traded recently ERY, which is 2x energy ETF. Currently, I hold OILD, which is a 3x ETF. So this strategy works on all ETFs. I would not recommend this strategy on inverse because of the nature, how it works. But apart from that, it works on all other ETFs.
So in the chat window, can you type in your email, please?
I'll do that.
That will help us. And then James asked the question, can the TOS grid be shared? What do you mean by that, James? You still there, James? Maybe not.
I was also thinking about the same thing. Perhaps he means the TOS script
Yeah,
or the setting.
they're talking about saving your screen as a link that you can then send to everybody else. Now, how to do that?
Hang on a second. I got these guys in here backwards.
You can just drag and drop them. Drag the MarketSmith one up, drag it up to the same box, let it go, drag the full one down to the there you go.
And now, so now Where do tell me, Rick, how do I,
Go to setup in the very upper right corner of your window. I haven't done this very much. Is that the right place?
You don't need to share anything. I pasted a link in the chat for everybody. You can click on it and it will open your Thinkorswim platform. That is the script for MarketSmith stochastic. You can put it on your chart and change the numbers to 533. It should already have it. You can also add the full code stochastics in the Thinkorswim library.
That's a good built-in Thinkorswim function. Thank you. Is that the same script that was shared last month, Yogesh?
Yes, same thing.
Great. Okay.
guys, it's well past the time and the poor people on the East Coast. I want to especially thank Eric for, he really stretched my mind and introduced many things that I hadn't heard of before, Eric, and really has my mind thinking about a lot of things here. And so I really appreciate, on a fairly short notice, you putting together a first-class presentation, buddy. So thank you.
No problem. Glad to do it.
And it's probably time for you to go to bed, buddy.
Me too.
Okay, I forget the date of our next meetup. The next meetup is November 9th. Right now, I don't know exactly what the topic is going to be, but I think we always come through and have a good one. And so most likely we will, because of the vote, I haven't fully decided yet, but it seemed like the majority of the people want us to start earlier than 7 p.m. Alaska time. And so out of respect of all of our lower 48 members, we most likely will move it up a minimum of 30 minutes and probably a full hour and start at 6 p.m. in November. And that should be user friendly to all of our fellow members down in the lower 48. I'm pretty sure that will get into place. So everybody, thanks for joining us tonight. Be safe out there. Be careful. It's a crazy market. And
Be careful out there.
But have fun too. If you're stressed out all the time.
Trade really small amounts.
Everyone have a great evening. And if you're in Alaska, welcome to the snow. Thank you.
Appreciate it, Floyd. Thank you, Rick.
And again, Eric, first class presentation.
Thanks, Eric.